For Irish startups looking to raise capital, a SAFE is a way to do this in a fast and efficient way, particularly in comparison to traditional loan notes. The word itself is an acronym for Simple Agreement for Future Equity. And it's essentially an arrangement whereby an investor will give the company money now for an unspecified number of shares in future. For early stage investment companies, a SAFE can be a more attractive option than traditional loan notes, and here's why. First, for founders who wish to preserve as much equity as possible in the early days and make sure they're not giving too much away. And second, for valuation reasons. Valuation can be a big issue for the majority of early stage companies. It can be very difficult to agree an objective valuation for a company that has no revenues or no significant revenues. A SAFE essentially solves this question by deferring the valuation question. The number of shares an investor will get will be dependent on a future investment round. The main benefit of a SAFE for founders is that it is not designed to be repaid once an investor gives the money to a company, in the same way that a loan note is. A loan note is a debt of the company, whereas a SAFE is closer to equity. Also, interest will not be accruing on a SAFE amount in the same way as it would in a loan note, and there is no maturity date triggering repayment either. Also, in terms of negotiation, it is typically more straightforward with a SAFE. There are really two key negotiation points, whether there's a discount or a valuation cap. A discount is essentially an agreement to give an investor future shares on the next investment round at a particular agreed discount. This can be anywhere up to 20% or sometimes even more. A valuation cap is essentially where the investor says now what they will agree to pay for the shares in future. The calculation of a valuation cap can have a significant impact on the equity that an investor gets and that a founder gives away. The calculation can either be done on a pre-money basis or a post-money basis. The pre-money basis is arguably more founder-friendly, and the post-money basis is arguably more investor-friendly. SAFEs are more established in a US context, but their uptake in the Irish market has continued to be slower. As a founder of an early-stage Irish technology company, you can still expect an investor to push for a loan note, or if they are agreeable to a SAFE, to push for more additional rights than you would typically expect to see in a US-style SAFE.